Hello and welcome to The Rate Stuff, your essential guide to all things mortgage. I'm Jack Izzard.
And I'm Peter Stimson.
Peter, it is peace in our time, sort of.
Sort of. I'm not quite sure the Israelis have got the memo yet, but yes, kind of.
Yes, it's true. The ceasefire, such as it is very fragile, hanging by a thread. But let's look on the bright side. We'll try and treat the glass as half full. And today we'll talk you through what now for the global economy and what now for the mortgage market. The ripples, the waves from this conflict will be felt for many months, and we'll help you unpack what that means for interest rates and for mortgages. Stay with us here on The Rate Stuff. It's peace, or is it taking the peace? This ceasefire is pretty fragile, isn't it, Peter?
It's very fragile. As we're recording this, it's just about holding, and we've got JD Vance meeting at the weekend with his Iranian counterparts to hopefully thrash something out which is a bit more permanent and satisfactory.
Yeah, so we're in this kind of limbo phase at the moment. The fighting has sort of stopped, but it's a ceasefire. It is not a peace agreement, and we are a million miles from where we were at the start of the war. Let's just take the example of those oil tankers that couldn't get through the Straits of Hormuz, that choke point off the coast of Iran for all those weeks. There's something like 800 of them still backed up, unable to get through, and there's just a couple or so going through each day at the moment. So we've still got this huge interruption in the supply of oil and LNG, and of course that is going to keep pushing up the cost of energy and presumably feed through into a bigger wave of inflation.
We are. I mean, even if the Straits opened on Monday, it's going to take months to resolve this properly. It's pushing through not just into higher petrol prices, higher energy bills. It's pushing through into food. We're going to have double-digit food inflation later this year because it's obviously relating to things like fertilizer, higher energy costs into the production of food. So, yeah, it's kind of embedded into inflation for the remainder of this year, I'm afraid.
Okay, so a big wave of inflation is coming, but the question is, how bad is it going to be? Let's have a quick look at the CPI chart for the last few years, and you can see where we are now, or where we were at the start of the year. It wasn't too bad, 3% CPI in the UK at the start of the year. Of course, anyone who was working as a broker in 2022, trigger warning if that was you, we saw a big spike in inflation then, up to 11%.
Yes.
There was an element of similarity there in that there was that oil price shock, that gas price shock during the Russian invasion of Ukraine.
Yep.
But that inflationary spike wasn't quite like the one you're expecting now, is it?
No, it was different. So if you go back to 2022, coming out of COVID to an extent as well, obviously supply chains sort of froze, stopped during COVID. People didn't work for a year in COVID, obviously managed to save up significant amounts of money. Coming out of COVID, people went kind of on a bit of a spending boom. Supply chains weren't kind of back in place. Oil, energy shock, kind of supply demand imbalance, kind of a whole kind of perfect storm scenario. If you come back to where we are now, only kind of expecting, I say only kind of expecting inflation to hit kind of 4.5%, 5%. So it's not kind of the same spike. It's also kind of a bow wave coming through because we've only, and again I say the word only, we're kind of looking like a 6 weeks period of disruption, albeit it will take a considerable amount of time to resolve it. But it's this kind of, wave coming through that washes through that hopefully in 9 months' time comes through the system. So it's not the same in terms of, exactly the same in terms of nature, and it's also kind of a temporary period as well.
Got it. All right, so some good news on inflation there. It's not the same sort of extent and not the same sort of duration.
No.
What does that then mean in terms of interest rates? Because we saw that huge spike in interest rates in 2022 in response to inflation. We've seen interest rates, or at least swap rates, go up dramatically since then. Take us through the next few months. What will we see the Bank of England do? How will its response differ to last time?
Very, very difficult one for the Bank of England. On the one hand, they've got to try and manage inflation. On the other hand, they've got the problem around growth. Growth is basically zero. It's probably going to go negative in the next quarter. They've also got the situation that consumers are getting absolutely battered from higher energy costs, higher food bills, filling up a cost of, your tank of petrol has gone up by about 20 quid. The view generally seems to be that the Bank of England is now going to probably just try and hold. If they put up interest rates, it's just going to hammer consumers again. It's probably not really going to do that much to control inflation, given that the wave is coming from abroad. It's not really going to change much by just putting rates up. It's just going to hammer consumers again.
Okay, so it sounds like you were saying that actually this time round, the Bank of England is going to kind of park its inflationary mandate, because as you know, its mandate is to keep CPI at 2%. But it sounds like this time it's just going to say, that can go fish. We'll focus instead on the damage to growth. The last thing we want to do is damage growth. So your case is quite compelling that they're going to hold the base rate for the rest of this year?
So my view, or what I think or hope the Bank of England does, is hold for the remainder or this year whilst inflation kind of does its thing and pushes through the system. The economy is in, like I say, is not a great shape. Inflation pushes through. We kind of get out to sort of October, November time. Inflation kind of comes through the system. We get back to, inflation kind of pushing down towards 3% again. If the economy's still not in a great shape, at that point, you can probably start to look to cut rates again.
Right.
So, my view would be looking, out 9+ months, hold, and then towards the end of the year, you're probably looking at another cut again.
Well, Peter, I'm delighted to hear you say that. Andrew Bailey, if you're watching, take note. This is all sounding quite encouraging from a mortgage point of view, but as we say many times here on The Rate Stuff, the base rate isn't the only factor when it comes to mortgage product rates. So let's take a look at the swaps chart now, and you can see there that huge spike in swaps during the conflict, and these are the numbers that people watch when it comes to fixed mortgage interest rates.
Yes.
So you're talking about the base rate staying put for the next few months. What's going to happen on those fixed interest rates?
Well, I think the market's probably overcooked this quite a bit. I mean, we're at 4, as we're recording this, we're at 4.11 on the 2-year. We're at 4.11 simply because the market is sitting there thinking, is this resolved? Isn't it resolved? Assuming it is resolved and we get some sort of more permanent peace deal next week, I think we could see the 2-year drop below 4%. We'll get the Bank of England meeting later this month. If the minutes and the vote is favourable, I think we'll get swaps dropping still further down sort of towards 3.75, towards where bank base rate is at the moment. If we kind of get an indication that the bank is inclined to hold at the moment, to seeing where inflation settles. So I think the market kind of got a bit ahead of itself, kind of panicked a little bit. Panic's probably the wrong word, but kind of wasn't sure where things were going to end up.
Well, if you remember a few weeks ago, in the depths of the conflict, we didn't know how bad things were going to get.
Yeah, absolutely.
So, yes, I take that point. All right, let's just go back to those swaps. In terms of actual product rates, do you think we could start seeing products 4.5, low 4s?
Yeah, absolutely. Soon? So, I mean, the rates will follow the swap down. They've gone up where the swap's gone, or they'll follow the swaps down. Again, you should get, it's going to be much easier, much more, much better for banks to start reintroducing products again as well. I mean, banks kind of want two things. They want lower rates. They also want some stability in the pricing curve as well, rather than rates kind of going up and down like an earthquake graph.
On that note, could we start seeing a lot of competition? Because I know a lot of lenders just pulled products and just pulled away from the market.
Yeah, absolutely. Yeah,
so some lenders could come out firing with really quite aggressive low rates to win share.
Absolutely. Yeah, I mean, you get rates coming back down and you get stability again. Absolutely, banks will be back in with good product ranges, good pricing.
Well, look, let's end there. That's a nice positive note to end on. It's been a pretty grim few weeks. Stay with us though for the big question, and we'll ask the question of what lessons the mortgage industry can learn from these last few tempestuous weeks. Black swan events are supposed to happen once in a blue moon, but those black swans, well, there's been a bit of a flock of them over the last few years, Peter. We've had that nightmare in 2022 with that huge spike in interest rates, that huge spike in inflation, another big spike in inflation coming our way following the latest conflict in the Gulf. It is a more uncertain world, Peter.
Yes.
Do you think that the mortgage market and brokers and borrowers are going to learn anything from this?
I hope they do. I mean, black swan events are supposed to be, like you say, these things that occur very, very irregularly, but they are becoming more common. We obviously had Liz Truss, then obviously we had Russia-Ukraine. We've now had the sort of Iran war, and there's lots of other geopolitical uncertainties out there. Obviously, China, whether something else kicks off in the Gulf, what's going on with Russia. And we've also got lots of political uncertainty in the UK we need to bear in mind. What happens if, Zach Balansky, Farage coalition gets in? That could have lots of unforeseen circumstances, or rather predicted uncertainties in the bond market. Bond yields could potentially go very high if someone like Polanski gets in. Lots of, potentially, again, unfunded tax cuts or tax rises, etc., etc. So I think the lesson really is, as we get to the bottom of the interest rate curve and the short rate graph going up again now to show you where we've been, we are probably, assuming we get through kind of, the Iran war and reaches the bottom of it, and we get to sort of the end of 2026 and we, end up with bank base round about 3.5, maybe 3.25, that probably is going to be the bottom of the interest rate curve. My thought really is, if you are a borrower and a broker, think longer term and potentially think about locking in longer term. If you go onto a 2-year fixed rate, I know they're probably a bit cheaper, but you are coming off in 2 years' time into a very uncertain world, and you will be coming off potentially in 2-3 years' time into a UK general election or into a market that, is not going to look necessarily that good.
Yeah.
So my lesson would be, if you can fix at a very or reasonably low rate for 5 years or maybe even longer, have a pretty good think about it.
Yeah, interesting thought there. I mean, the UK mortgage market has all been built around 2 or 5 years. Other countries, 10 years, 20 years is the norm. It's probably a long jump for Britain to move to a market like that. But as you say, there has been this huge uncertainty. Someone with a nice long 5-year fix at the moment probably thinking, thank goodness I fixed. I mean, this is just brushing over them, isn't it?
Yeah, it's obviously depending on everybody's circumstances. So, if you think about moving home or et cetera, but if you're in for your other home, it may be worth considering thinking about paying a bit more for that certainty, given, where we've gone and where we potentially could go.
Yeah, what price certainty?
Exactly.
Okay, well, good thoughts from Peter there. Peter, I'm glad to see you just returning to form just at the end there, sounding a little bit negative, because you were sounding quite chipper for a while.
I did optimistic. We have to do pessimistic.
You checked yourself there. Exactly. So look, a nice thought to end on there. I'm Jack Izzard.
I'm Peter Stimson.
You've been watching The Rate Stuff. Do join us next time as we delve deep into the mortgage market and what it means for you.